32-year high inflation, RBA pushes rates even higher, property prices tip to free fall, rent rises roaring across the country. In today's video, we're going to cover the latest inflationary data, followed by how high interest rates are going to go, and finally look at the biggest contributors to inflation. You've probably seen the headlines recently. We're going to look to cut through the panic and get through to the facts. And if you're new here, smash the subscribe button below because I talk about property and finance. Now, if you're interested in using a mortgage broker for your finance needs, then definitely get in contact with us. Our details are down below. Official figures show prices are up 7.3% over the past year, the steepest annual rise since 1990. This is driving bets the Reserve Bank will push interest rates even higher, which you'll see the 7th consecutive rate rise happen on Melbourne Cup Day. The headline consumer price rose by a large 1.8% in September's quarter. The annual rate surged by 7.3%. The ABS said new housing, gas and furniture prices were the biggest contributor to the 1.8% jump in prices during the September quarter. We're going to break this down into a little bit more detail later. As we can see on the screen here, we can see inflation has steadily increased over the last 3 quarters. The Reserve Bank only getting this data every 3 months. This has now changed. We're going to start to see it coming through monthly, and this might give some better insights, some new data coming to light each month with inflationary details coming through and really getting a pulse check on what's going on rather than waiting the 3 months that we've been accustomed to. So what does this mean for mortgage holders, and more importantly, how high are interest rates going to go? I had a client reach out with me recently. She's a nurse and she overheard the doctors talking about interest rates could get to 8%. It actually scared her and she was absolutely worried as to how higher interest rates were going to go. So let's break down what's going to happen, especially with this new inflationary data that's come out. Now, in the short term, the financial markets have fully priced a 25 basis point increase in the cash rate in November's meeting. This would take the cash rate to 2.85%. And there has been ramped up expectations that the central bank could go harder. Some economists are even saying the cash rate could go up by 50 basis points on Tuesday. Inflation in Australia is red hot right now, and in many parts of the world. And it is expected that the Reserve Bank will respond by raising the cash rate in November's board meeting. So we can see here CommBank's expectation is that the Reserve Bank will deliver a 25 basis point increase in November and then another one in December. Now, it's worth noting that the Reserve Bank has been super aggressive with their tightening cycle. We've seen a 2.5% increase on the cash rate from May to October's board meetings. These rate hikes have actually had no impact on June or September's quarterly inflation outcome. Therefore, the 6 rapid rate rises that we've had and the 2 more that are expected are going to potentially have little to move the needle on inflation for December's quarter. In fact, inflation is a lagging indicator. Policy tightening will impact consumer inflation in 2023. This comes as we saw NAB as well as Westpac upgrade their peak cash rate forecast to 3.85%. We saw ANZ also coming in at 3.85%. CommBank coming in at the lowest, saying that they see the cash rate peaking at 3.1%. So as we can see on the screen here, the official cash rate at the moment is 2.6%. If the predictions that Westpac, ANZ have that we hit a cash rate of 3.85%, we can see another 1.25% increase on the current rates that we have at the moment. Now, what does that mean if you're a mortgage holder, and what does that look like from a repayment point of view? Well, let's say you've got a mortgage, say it's $500,000 at the moment. The average interest rate is about 4.5%. You're currently paying $2,533 per month. Let's say the official cash rate predictions are right, and we do see another few rate rises this year, a few more next year, and the cash rate does increase on the higher end of the prediction by another 1.25%, what that's going to look like from a repayment point of view. The rate's going to go from 4.5% to 5.75%, and your repayments are going to increase by about $385 per month to $2,918. Now, this is based on the higher end of the forecast. We saw CommBank's chief economist saying that inflationary data came in stronger than expected, but they still retain their call that the Reserve Bank will lift rates by another 25 basis points in November's meeting and potentially another 25 basis points in December's meeting. At that point, they forecast the Reserve Bank will wait and see how a lot of these lagging indicators perform and what comes of it in 2023. As we can see here from some of the bank forecasting, we can see that the cash rate might not actually get to 8%. It might be that we're going to get in the high fives from an interest rate perspective. It's still going to put pressure on a lot of households. And as the Reserve Bank has been very clear in stating, they need to get inflation back down to their target level of 2 to 3%. As we see with a lot of this data, there is a lot of lag time between when all these interest rates have gone up and when we might see inflation start to come down, which is expected to happen in 2023. We've also seen the cost of buying or building a newly built home climb a further 3.7% in the past 3 months. It's been up 20.7% over the past year alone. Even though relatively few people buy or build new properties in any given year, it's still such a big expense that carries a very heavy weighting on Consumer Price Index, published by the Australian Bureau of Statistics. Some key issues have been labour shortages that have led to higher costs for labour, contributing to the rise of new dwelling costs for the quarter. We've also seen rents rise in capital cities by 2.8% in the past year alone, with nearly half of that growth happening in the September quarter. Sydney and Melbourne rents started to catch up with soaring costs of other cities. Another big contributor to price rises over the past year was automotive fuel, which is up by 18%. However, petrol and diesel prices fell by 4% last quarter, before the discount to the fuel excise ended last month. Consumers in some states were insulated from even bigger rises in electricity prices with government rebates, but they will feel the crunch when the effect of these handouts fade out at the end of the quarter. Electricity rose by 3.2% for the quarter, with rises across the country offset by Western Australian Government $400 electricity credit, with smaller credits offered by Queensland and the ACT governments. The Australian Bureau of Statistics said the biggest increase remained concentrated in goods, with 9.6% annual surge, the biggest since 1983, while the cost of services rose a modest 4.1%. As we can see here, inflation has increased. It's widely expected that inflation is going to peak at 7.325%. This is probably going to be higher than expected. A lot of the times with these forecasts, they're never actually accurate, but we know inflation is going to keep going up. However, there is a lag effect. With so many rate rises, in 2023, we might start to see inflation come back down and moving closer to the Reserve Bank's target band of 2 to 3%. Once it starts moving back, we might actually see the Reserve Bank sit back and wait, because we know a lot of these changes take time and they're going to want to see how quickly things change. And in a lot of times with these cases, you can move the needle too far, and then that's when we could move into a recessionary phase. I guess no one's got a crystal ball, but based on what we can see with the bank forecasts, the cash rate is expected to get anywhere from 3.1 to 3.85%. At the high end of the forecast, if the cash rate did get to 3.85%, that would make mortgage rates around that 5.8%. It's unlikely to get to 8% like that client asked me the other day, but once again, it's a watch and see. This is based on the data we have today, and we're expecting hopefully things to turn for the better next year. So what do you think? Leave a comment below. Let us know how high you think inflation is going to get and where you think rates are going to go.